It's another business week. Good morning and welcome to Business Morning. Nigeria officially entered into a recession over the weekend following the release of the third quarter GDP numbers. Economic recession is defined as 2 consecutive quarters of negative gross domestic product growth. The gross domestic product contracted for the second consecutive quarter by 3.62% in the third quarter of 2020. But the good news is that the contraction was not as deep as was envisaged. All right, let's look at the highlights of the figures. In the third quarter, real GDP contracted by 3.62% year-on-year, an improvement of 2.48% points over the minus 6.10% growth rate recorded in the second quarter of the year. Growth in the third quarter 2020 was slower by 5.90% points when compared to the third quarter of 2019, which recorded a real growth rate of 2.28% year-on-year. The cumulative GDP for the first 9 months of 2020, therefore, stood at minus 2.48%. Look at the oil GDP, 13.89% down, as against the minus 6.63% recorded in the second quarter of 2020, indicating a sharp contraction of minus 20.38% points relative to the rate recorded in the corresponding quarter of 2019. The sector contributed 8.73% to total real GDP in third quarter 2020, down from 9.77% in the corresponding period of 2019 and 8.93% the second quarter of 2020. Non-oil GDP contracted by 2.51% as against minus 6.05% in the second quarter of the year and 1.85% in the corresponding period of 2019. In real terms, the non-oil sector contributed 91.27% to the nation's GDP in the third quarter of 2020, higher than its share in the third quarter of 2019, which stood at 90.23%. and the second quarter of 2020, which stood at 91.07%. Let's have this conversation now with Dr. Biodo Adedipe, an economic expert and the chief consultant at B. Adedipe Associates. Thank you very much, Dr. Adedipe. Thank you for joining us on the show. Good morning.
It's my pleasure. Thank you, Chimeze, for having me on the program.
Yes,
good morning to you and viewers.
Good morning. It's no news now that Nigeria is in recession. It was expected, but did it matter to you that the rate of contraction was not as high as was expected?
Well, I will say that what we are seeing is not a surprise to me, and it is very simple logic. What is happening to Nigeria is happening to every other country in the world, except perhaps China. And the reason is also obvious. Now, when the COVID-19 impacted the global economy and, of course, all regional and national economies, by the end of the first quarter of this year, we all made projections as to how this was going to impact economies. I remember vividly that in our firm, the projection we made was that this year, our economy was going to shrink by over 9%. Now, but we also put a caveat to that will depend on how the government responds to that in terms of intervention, stimulus packages, which we saw was already in conversation all around the world. So we saw the central bank respond. We saw also the federal government respond. So 2 months later, that was in May this year, we revised that estimate to 7.7%. So, and we kept tracking that. So if you look at the latest projections, now for me, that the data came out on Saturday to confirm what we had known all the while, that the economy was going to go into technical recession. The third quarter of this year was not news to people like me. But what is more important is, when will this economy get out of recession? If you look at the data, as it were, the economy actually has started climbing out of that recession. And it is very simple logic again, in terms of economic analysis. You had a dampening of 6.1% second quarter, dampening reduced to 3.26% by the third quarter. So what that tells you is that if you look at the chart, which we construct, I already have the chart, okay? that chart shows clearly that there's an upturn in the rate of growth of GDP, as it were. So the expectation is that by the time we finish this quarter, we see a further improvement. And if we go by the projections by the National Bureau of Statistics, we will likely end the year at about 4.2% dampening for 2020, which is a good report, considering what is happening to other countries around the world. So that is what I will say for now. So it is nothing for us to panic about. It is simply about what caused this. And it's Nigeria and Ireland in this matter. And the only reason China is an exception, because China went into recession, was the first to be impacted by COVID-19. They were also the first to respond by locking down the economy. China also was the first country in the world to reopen its economy. And so they also got it right. And by the second, third quarter, the Chinese economy has started growing. It's the only economy projected this year by the World Bank, IMF, and people like us who are economic analysts that will end up this year with a growth rate of the GDP.
Right, Dr. Adenipe, I'm glad you're sounding very optimistic now. Okay, talking about the IMF projection, in its October World Economic Outlook report, the IMF projected that Nigeria's economy will contract by 4.3% in 2020 in real terms. Now, this is a 1.1% improvement from the minus 5.4% that was projected in June and deeper than the minus 3.4% projected in April. Now, Dr. Adenipe, I recall that when IMF made that projection of 5.4% in June, I had you on the show, and you gave your own projection, which was quite, I mean, for someone like me, I mean, we would think, yes, was quite frightening. And permit me if we could listen to what you said. Here's what you said.
2019, our GDP was 145.64 trillion naira. That's for the whole year. That will talk about the value of economic activities that took place in Nigeria. Now the question is, if we divide that by 4 and make it an average figure quarterly, that gives us about 36.4 trillion. Okay? Now, what I did was to dampen that by 15% on a quarterly basis. And so if I dampen that, that brings me to first quarter of this year. Remember, the first 2 months, yes, we were doing normal economic activities. Then we began lockdown gradually. So if first quarter saw a dampening, and then second quarter further dampen, and most likely the way we are going, we may see even further dampening in the third quarter. So the only escape will be the fourth quarter, assuming we have put COVID-19 under control. Let me say with the help of God. So now, when I put figures projected for GDP for each of those 4 quarters of this year, I came up with a figure of 98.63 trillion naira. That's a huge dampening from 145 in 2019. And when I put figures to it, that's about 32.28% dampening of this economy.
32.28% contraction. Dr. Adenipe, that was your projection earlier this year. Has that changed?
Certainly it has changed, because the way it works in economic forecast is you look at the dynamics. How has the government responded in terms of the 3 planks of economic policy? That's talking about fiscal policy, the monetary policy, and of course commercial policy. So the question will be, between that time and now, what have we done? Have we truly responded we were supposed to respond? And indeed we have, in looking at what the government did with respect to the health sector, with respect to manufacturing, and of course several other key sectors of the economy. So what has happened between then and now is that very frightening projection had actually been turned round, in the sense that we are not going all the way down. It's the same thing you see in the IMF economic outlook. Okay, they had a more dismal picture when they published the June outlook. But the October outlook looks a little bit more friendly. And why is that so? Simply because they've also factored into their projections the changes in terms of policy responses, and now the economy itself is responding, that is the economic actors. So those are the changes that come. And if you truly want to be professional in projecting growth of the economy, you must take those issues into account. and completely do away with sentiment. So the reality today is that if you look at what has happened between then and now, a good lot of interventions have come into the economy, and that was what we were canvassing at the time. And what we call that is we want to create a sense of urgency. So that was why you do such projections, create a sense of urgency so that government will respond appropriately. Okay, so we see that happen here, and of course in a few other countries around the world. So that was why also at the time, what I said then was that Nigeria as a nation should forget about talking about debt or sovereign debt. That the issue in a time of crisis is to ensure that you don't go the full cycle of what we projected then when I made that projection. Now the full cycle of crisis would be you go from health crisis, you don't address it, it becomes economic crisis. You don't deal with economic crisis by interjection and intervention variously, it will become a humanitarian crisis. If you don't deal with the humanitarian crisis, it will become a security crisis. That is the pattern generally. So intervention then makes it to stop at the level of economic crisis. And so your economy therefore might dampen, but you don't allow it to go all the way down. And that is what is showing our data as of today. 6.1% dampening second quarter, and 3.2% dampening in the third quarter. It's following the projection exactly as we expected it.
Now, talking about what government has tried to do so far, let's look at the 2021 budget provisions. We're talking about, how we will have to get out of this recession. Now, that budget is tagged Budget of Economic Recovery and Resilience. The proposed revenue was 7.89 trillion naira, and expenditure was pegged at 13.08 trillion naira, resulting in 5.20 trillion naira fiscal deficit. Recurrent expenditure is put at 5.65 trillion naira, capital expenditure 3.60 trillion naira. Now, does that tell a story of a country on the path of economic recovery?
Yeah, now I will put that in context of where we are coming from. Now, this has been a major challenge for economy, and I will straight two things in that very quickly. The first is that here is a country that is hydrocarbon dependent, and you showed that also in the numbers that you shared with us earlier on. Your sector is weakening globally. Why? Because there's demand for hydrocarbons is also shrinking. And of course, when you look at that, vis-a-vis the fact that the price of crude oil also has been struggling. In fact, for Nigeria's burning light, it's been in the range of about $40 per barrel in the last 2 to 3 weeks. Okay, so what this means essentially is that you have a situation where your expectation in terms of foreign earnings has weakened a bit. You are producing less because you must comply with the stipulation of OPEC Plus on the one hand. Now, secondly, the price has dampened. So what you expect as earnings is going to drop. That is the reality Nigeria is facing. Now, the other side to it is, can you then drive non-oil revenue, aggressively and significantly? Well, to some extent, but not as aggressively as to make up totally for the dampening of earnings from oil. And that is what you also see in that budget. There are a number of revenue, drive strategies in there to grow revenue, block leakages, and other sort of things. So the one critical thing there is that, as you narrated, if you look at the numbers, revenue vis-a-vis expenditure projected. Now we have a deficit that in fact is beyond the threshold in the Fiscal Responsibility Act. So the response to that in explanation is very simple. Now, does that act permit the federal government of Nigeria to go beyond 3% in terms of fiscal deficit, that is deficit to GDP ratio? Does that act permit? It says, yes, you can do that when you are in a crisis situation. So the question then is, are we in crisis here in managing this economy? By all means, almost every country around the world is in crisis, managing the economy. So that means within the context of what we have, we are in the right direction. What I still see as a challenge is the fact that the bulk of our expenditure is still a recurrent. So I think is an area we need to really work on. There are still some things we can cut off, especially in a time of crisis like this. When you are in an emergency, you focus on the important and critical expenditure items. So some are not as critical and important, to running the economy. So and that is the question we should begin to ask ourselves in this particular matter.
Yeah, yes, you're talking about looking at our cost of governance there. Now, the government has been talking about going to borrow. Now, the question a lot of people would ask, are we borrowing to pay salaries and maintain our high cost of governance, or are we borrowing for developmental projects?
Very important question you raised there. Now, as an economist, I will tell you there is nothing wrong with borrowing, okay? But what is more important there, as rightly said, is what are we using the borrowed fund for? If the government steps out to borrow money for projects, I am all for it. And the reason it goes that way is this. If you borrow to do projects that relate to economic infrastructure or maybe social infrastructure relating to education and health, that means you are ultimately going to enhance productivity. If productivity is enhanced, ultimately at the end of that value chain, government revenue will also increase. So which means you borrow to invest in projects that will expand capacity to produce more. The capacity to produce more will also result eventually in more revenue for government, in which case eventually government gets empowered to be able to pay back those borrowed funds and also to service it. So that makes a lot of economic sense. But if it is borrowing just to bridge the gap in funding your recurrent expenditure, then I will say that is bad borrowing, as we describe it. That is not the direction our government should go. But I think it's also good we must emphasize this. Yes, government has been saying this in the last couple of years, that when we borrow, it is for projects. But we truly want to see an accountability to Nigerian stakeholders that yes, we borrow this much for this project, and this is what we have delivered. And that is why people like me canvass that our focus should be more on deliverables. If we borrowed $500 billion, $1 million, just to illustrate, the question will be for what project? So let's see what we deliver with that. And then we can also do an estimate of the value of what is delivered compared to the amount borrowed. And that is when we can begin to say, yes, we have borrowed in a productive manner. Borrowing can be productive, but it must be targeted at things that enhance productivity and your capacity to generate more revenue.
Okay, let's look at some of the reforms the government has tried to put in place. Removal of subsidy, cost-reflective tariff. How will these help growth?
Well, I will say that there are 4 things that have happened recently that I believe altogether are good news for the economy and the stakeholders. Now, there is the KAMA 2020 Act that the President signed in August this year. And if you look at that carefully, that repealed the 1990 Act, which means we have been running on a 30-year-old act with respect to governing the business space in Nigeria. So that is some good news for economic stakeholders. Now, the second one is more recent, and that is the one relating to the banking and finance sector. That is the BOFIA. Again, you look at that, the one we had run with up until date, before the President signed this recent one into law, had been since 1991. That also is good news because a lot of the challenges that the banks are facing, which is in fact one of the impediments to banks supporting the real sector, have been now addressed in that new act, okay? No particular act is perfect anyway, but it's a significant improvement over what we had since 1991. Then comes to what you mentioned in terms of reforms, which is the deregulation of the oil sector. Now, some people still say that, oh, the sector still needs to be regulated. And I just wonder, what else do you want to deregulate? The market drive the price of kerosene. The market drive the price of diesel. The market now drive the price of gasoline, that is petrol. So what else will we be talking about here? Other than the fact that we now should be thinking about how to get NNPC out of the commercial business of importing refined products to Nigeria and selling them.
Yes,
so
Dr. Adedipe. Dr. Adedipe, that's a very, very relevant issue that we really need to talk about, but that would be when we come back from break now. In the meantime, of course, the Monetary Policy Committee of the Central Bank is meeting, the last one for the year, in the midst of a recession and high inflation rate. So I would love to have that conversation with you, Dr. Adedipe. I hope you don't mind spending a little more of your time with us. We'll be right back. Thank you for staying tuned. Well, still have Dr. Adedipe there. Thank you very much, Dr. Adedipe, for sparing more of your time with us. Well, still talking about deregulation, which you mentioned earlier. The government said, yes, it has deregulated the downstream sector, and yet it still has control over the price of petrol. We've seen what is happening recently with government hiking the price of petroleum product, and that is not going down well with Labour. And here is the explanation the Minister of State for Petroleum gave for this present hike. Let's take a listen.
Today, the price of crude oil go up, then it means that the price of the feedstock has gone higher. It will also affect the price of the refined product. And that is why you see that product prices are usually not static. It depends on the price of crude oil, which goes up and down. That is why we say deregulate, so that as the price go up or down, you begin to go up and down as well at the pump. Before now, we fixed it, which was not optimal for us as a country. So we say, look, our earnings are not fixed because our earnings are dependent on crude oil price. If we fix it at this end, then it becomes unsustainable at some point. So let us keep it floating, so that if crude oil prices go up, then you will see a reflection of that. If crude oil prices go lower, you see a reflection of that at the pump. Now, what happened recently was because of the announcement of a vaccine for COVID by Pfizer. With that, crude oil prices went up a little bit. If you've been following crude oil prices, you would have seen that crude oil prices went up a little bit as a result of this announcement. So when crude oil prices go up a little bit, then you will see that instantly reflect on the price of petrol.
Now, Dr. Adedipe, what do you make of that explanation? I mean, we know the volatility in the oil market. In fact, he talked about when the vaccine was announced. Shortly before the vaccine was announced, I think a week before the vaccine was announced, when the global economy, Europe, the US, they are talking about second wave of COVID-19 and the possibility to lock down, we saw oil price come down to as low as $35. But the price of petrol didn't come down. So how come? Now, does it mean that the moment we see price of petrol go up a little bit, we raise the price? Is this the type of deregulation we should be, talking about now?
All right, thank you so very much. Now, I will situate this in context of the way the exchange value of a currency is managed by central banks. Now, there are two extremes. There is the extreme of fixed rate on the one hand, and then on the other hand, there is the extreme of floating rate, all right? But in between, there are variants that include adjustable peg, crawling peg, and the rest of them. Now, from the explanation of the minister, what we actually are doing with the price of petrol is not floating, or they use the word floating. We actually do what is called adjustable peg, which the government is the one that observes the market and then adjusts the price as it deems appropriate. Okay, that is called adjustable peg. So until the market forces interact to determine the level of the price, we cannot say we have adopted a floating rate system. It is not floating rate yet. It is adjustable peg. And that really is my own position on this. And the position is very simple. Now, if we actually say that we have deregulated as announced, all right, it shouldn't be by way of government fixing the price and moving it in the form of an adjustable peg on the one hand, and then secondly, we won't even have the governance structure that still has the petroleum, pricing agency there. And you would also have a situation where NNPC as a government agency is still involved in the importation and distribution of refined petroleum products. Now, if those still exist, the government still has a finger on determining the price of the pump head price of petrol. So, and that is not what we understand to be a floating pricing system. So if the price system is floating, then it should be largely an interaction between the various factors in the market. So we are not yet there as we are. What we run presently, in my interpretation, is adjustable peg pricing system.
Now, Dr. Adedipe, don't you think the major challenge there is with the central bank? I mean, what is happening with the currency? Now, should the central bank continue to defend the naira as it is?
Well, I will say that's a very good question. But the question I will also pose to anyone who says central bank is defending the naira is for that person to, in all confidence and honesty, tell me what the primary responsibility of any central bank in any country around the world is. If your central bank or reserve bank, as the case may be, cannot defend your currency, then the governor of that bank or the president has no reason to be in that office. Now, the exchange value of a currency is driven by many, many factors. In fact, for me, I don't see it as Central Bank of Nigeria defending the naira per se. That is not the way I interpret it. The way I interpret what Central Bank is doing is to ensure that the two major legs of the relationship of our economy with the rest of the world are closely monitored, and also where monetary policy can intervene, then we apply monetary policy there. On the production leg, and that is still where our problem is. If you look at our import data as published by National Bureau of Statistics, in the last 6 to 7 years, in fact, I will back it up to 7 years, 2013, our import bill per month has been growing in this country. The latest data is the highest figure in the last 12 years. $1.374 billion per month of imports. So the big question is, why do we import so much? It means we are not producing enough here. And once you don't produce enough, then the finance leg comes in. You either have to borrow or create an environment that will make foreign investors to bring their money here. So that is what brings a balance on your balance of payments. It's a balance sheet kind of. So the real issue here for Central Bank of Nigeria, and for me as an analyst, they have done a fantastic job in terms of intervening in the economy. Because in the last 4 years, the Central Bank of Nigeria has placed a lot more emphasis on its development role rather than the primary monetary role. And I will say that with every sense of responsibility. Since the global financial crisis of 2009, central banks all around the world have moved away from inflation targeting, which was the discourse for central banks from early 1990s. Okay? In recent times, we call it pragmatism in monetary policy formulation and implementation. So for us, therefore, if you say central bank is defending the naira, that's right, that's the way they're supposed to go. But in what manner? If defending is making foreign currencies available to the manufacturing sector, that is what we need. That is pragmatism. That's what this economy needs. We need to keep producing, and that is the direction, in my own view.
All right, Dr. Adedipe. Yes, talking about the central bank, of course, they've started their meeting today, and that's the last one for the year. And just as you said, not just Nigeria, African central banks, of course, including Nigeria, maintain that they still target inflation, but it is clear that the focus this year has shifted firmly to growth. Interestingly, in Nigeria, naira depreciation and rising costs suggest upside risks to inflation forecasts, and here we are in recession. So what will the MPC do now? Do you think they've exhausted their monetary policy options?
Well, the perspective I will take to this is, if I were a member of that committee, what are the things I'll be looking at? Yes, normally they look at what is happening all around the world, come within the domestic economy, and then look at the banking and finance sector, and then relate all these to the other sectors of the economy. Critical questions that I think they should be aiming to answer are, one, the direction of the economy now, is it going in the right direction? For me, I will say yes, it's going in the right direction. Why do I say that? If the upturn in the chart of the growth of our GDP is pointing towards recovery, that means we are in the right direction. So that is number one. Then number two will be, what exactly do we want at this time? Which of course is one of the remarks you just made. If we want growth, then what that tells me is that this is not a time for us to worry about inflation, because in economic management, there is always a trade-off between growth and inflation, all right? So if we want growth, then you face growth and do everything required to make your economy grow. And of course, the way of growth is what takes you out of recession to start with. The way of growth now is to also look at, where do we want that growth to happen? We want it to happen in sectors that also create jobs, okay? For example, looking at our GDP, there's a massive shift between the second and third quarters of this year. Second quarter of this year, ICT became number 2 contributor to GDP, ahead of trade, the second quarter. Now, third quarter, we saw agriculture's contribution to our GDP go above 30%, which is the first time that will happen since we rebased our GDP 10 years ago. Now, these are things to take note of when you are interpreting data rather than going mechanical. Because I've seen people say, oh, our economy, this is the worst recession in the last 20, 30 years. That is mechanical analysis. The reality is that, where do we create jobs? Which sectors will create the jobs? And then, if we want those sectors to create jobs, what must we do in order to incentivize those sectors? What kind of infrastructure? Where is it needed? That will be the direction. So if we are going to therefore tinker with the, reserve requirements, which is what the monetary policy will be talking about. We talk there about the monetary policy rate. What should they do with it? If I were a member, I would say, leave it as it is. Because to worry about inflation now for me is a kind of aberration when you desperately need growth, all right? Then we're not talking about the other reserve requirement, cash reserve for the banks, the asymmetry, corridor, and all of those liquidity requirements. I would still recommend that they should leave those ones where they are. Because there's very little you can do with interest rates when rates are very low. And of course, what that tells you is that if rates become so low, and that is happening to central banks around the world as we speak, if interest rates have gone so low, that means there is very little you can achieve by moving rates either down or up in the situation we are in Nigeria and in many countries in the world. So that means we have to go the way of what we call, creating money out of the thin air. That is putting money on the balance sheet of banks. Okay, I want to make it easy for everyone listening to this. So putting money on the balance sheet of banks is for central banks to buy securities from the banks so that they can create liquidity for the banks, so that the banks in turn can lend to the risk sector. That is the whole essence. So as much as possible, the focus should be on how do we de-risk the risk sector so that the banks can begin to lend more to them. And there's a lot of improvement we have seen already in the new banking, and finance act that the president signed into law early this month.
Well, you're saying that we should think less about the inflation, but then the central bank wouldn't take that option. They are still concerned about the high inflation. So one would want to understand the nexus between interest rate and inflation. And then, is it possible to have a lower interest rate and, of course, a lower inflation rate? Is it possible?
All right. Now, the relationship between them is this. The normal interest rate you and I encounter when we interact with the banks and the financial markets is called nominal rate of interest. Okay? What we call the real rate of interest is to subtract inflation rate from the rate of interest. So what you come out with, if you look at MPR today, for example, and the rate of inflation above 40%, that means you have a negative rate of interest. What does that mean for an investor? To an investor, it means I cannot realize sufficient return on my investment in the money market that will give me a rate greater than the rate of inflation. So in which case, the money market will no longer be attractive to the astute investor, all right? So such investor will therefore look for alternative markets to invest his money. That, of course, is partly an explanation for what is happening in the stock market, okay? Now, the other side to it is that if you look at that rate of interest as we speak, it is still double digit anyway. There is a general desire anywhere in the world for single digit rate of interest. But the reality today is that when you are dealing with, interest rates, inflation rates, exchange rates, there is what you call differentials. Differentials means if our economy is doing a lot of trade, for example, with China, just to illustrate, then the rate of interest in China should become of interest to us. So the difference between our own interest rate and that of China should become of interest to the Central Bank of Nigeria. We call it interest rate differential. The same thing goes if most of our trade is with China. We must be concerned with the exchange value of the Chinese currency. So in which case, talk about exchange rate differentials. Now, it is the observation of the interaction between these and the trade flows, and of course, the impact of this on capital flows. Capital flows inwards and also flows outwards, inflows and outflows. All right. So the interplay of all of these are what the FPC is going to consider. It's not just about looking at the rate of inflation and then compare that with the rate of interest. But they look at that and many other variables and then come to a decision. What exactly is our goal? The goal will determine the instrument. And we must not also forget that the inflation rate as a target is intermediate in central bank. It's an intermediate target. All right. So the idea then is that we want to achieve that. But how do we get to it? How do we even measure inflation rate? What do we have in our basket of commodities that we use to construct that? Those are questions we should be asking ourselves. If what is in that basket, for example, is we assume rice is a staple food for every Nigerian, then we forget that there are other things Nigerians also consume, and possibly some of them are in the basket. And if I'm choosing for yams, for example, you then get to a point where there's a lot of yam rotting away where it's not got into the market where it is needed. So that now doesn't feature in that your basket. So the basket also has to be reviewed to see whether what you consume today are the things in that basket we're going to construct our inflation, our price index.
All right, Dr. Deregulation. Yes.
Inflation rate.
Yeah, Dr. Deregulation, we really don't have much time, but in less than 2 minutes, I'm going to take a quote from you on your recent presentation at an event organized by the Nigerian Economic Summit. You said Nigeria needs a clear and single policy anchor to drive growth and competitiveness. So what policy anchor are you advocating? What sort of synergy would you love to see between the monetary and fiscal authorities, particularly with huge possibility of COVID-19 vaccine coming? How can Nigerians get it? What can government now do? We are in a recession. We have to get out of it.
That's right. Thank you so very much. Now, when we, advocate for policy anchor, the whole idea is that you cannot be investing your resources in all the sectors at the same time. It's also part of what you call the cluster concept, okay? The way it works is, if, for example, we look at our GDP and contributions to it, well, that is the actual value of economic activities taking place here in Nigeria. Now, 6 sectors have dominated contribution to GDP in the last 10 years. In fact, the data for the 3rd quarter of this year, which just came out 2 days ago, shows clearly that those 6 sectors accounted for 81% of the value created in our economy in the 3rd quarter of this year. And that is agriculture, you see manufacturing, you see mining and quarry, you see real estate, you see ICT, and you see trade. In order of contribution, agriculture number 1, followed by ICT, then you see trade, you see manufacturing, mining and quarrying, and then real estate. The question is this: if we choose any 3 of those 6, because they've been consistent over the years, if we choose any of those 3 and adopt them as our policy anchor, that means every capital spending of the government, there will be a certain percentage minimum that we devote to creating infrastructure that will drive production in those sectors. When we therefore construct roads, when we therefore talk about power, when we talk about manufacturing factories and the rest of them, we are looking at those that will connect to those sectors such that they can get materials into them and get the output out. So that becomes your policy. So that is essentially the concept.
Thank you very much, Dr. Adelekpe. It's always a pleasure talking to you. Thank you for sparing your time to us.
Thank you for having me.
We'll take a break, and when we come back, we'll look at the activities at the local market. Do stay with us. All right, let's look at the market. The equities market last week, after 8 weeks of respite, the bears staged a comeback, dominating the market on 3 of the 5 trading days of the week. The all-share index settled below the 35,000 psychological mark breached in the prior week, closing at 34,136.82 points. Investors sell down in UBA, Dangote Sugar, Flour Mill, Stanbic, Zenith, and Dangote Cement drove the benchmark index 2.6% lower, first weekly loss in 8 weeks. Now, the medium-to-date return moderated to 27.2%, while the year-to-date return for index declined to 27.2%. Performance across sectors was all broadly negative, except the insurance, which went up 0.5%. That closed marginally positive. The banking was down 6.0%, oil and gas down 4.4%, consumer goods 4.3%, and industrial 0.7%. Activity level was mixed. Volume grew strongly by 153.8% in the week, while value declined 38.7%. All right, let's talk to Rotimi Fakejo, a stockbroker. Good morning, Rotimi.
Good morning.
So Nigeria has officially entered into recession, but do you still see scope for expansion and valuation multiples as the depressed yield environment remains compelling for yield-seeking investors to rebalance their portfolio towards equities?
Well, the news of Nigeria entering into recession is not a fresh news to those who have been watching the economy. It's been happening in other climes, but looking at it deeply, is nothing new coming to Nigeria. It's quite expected. And looking at that, at the way investors may want to look at their portfolios, I think what we saw on Friday was quite a major one. And we saw a huge drop in the market due to the fall in the prices of securities in industrial goods and to an extent communication. But for me, I believe strongly that the fundamentals of the companies have really stayed too strong, having weathered through the COVID-19 lockdown, except if there is another which we do not pray for. That is the only thing that may really affect things negatively. So investors rebalancing their portfolio and trying to see how they can maximize value. I definitely panic setting last week, and with the GDP report, we're going to see more panic this week. But I don't see really impacting for too long. What would have made me to be more afraid was that if we had had so much presence of foreign portfolios around us there, that would have worsened the matter. But we have had a lot of reduced presence of foreign portfolio investors. So even if investors panic and sell off, then definitely they will not have any reason. They will have every reason to come back and buy later, because that the equity market is where value lies now for investors that can really understand what it is about investment.
Yeah. Now, last week we saw quite a number of the Tier 1 banks, long expected. They published their results. Were you impressed?
Yes, I saw majority of the banks turned in their result on Friday. And looking at each of them, I think we had different things coming in. Some, especially First Bank, posted a high level of impairment charge for loan loss. And that has been a very usual trend for First Bank. and reporting such a figure is nothing new at all. And for a security like UBA, Zenith, and others, I think it's quite a different ball game, because we still saw quite a reduced proportion of their drag down in their profit, not coming from the mainstream investment, but from their operating expenses, especially UBA. We saw an increase in their operating expenses from 161 billion to 192 billion. So you factor out that figure, then definitely you still see the bank making huge profit, even in spite of other factors. So I think investors need to look at the real figures of the financials and not just the top line and the bottom line. I mean, so that way they can make a more informed decision about their investment. So I believe that things are still looking good in the market, and investors still, to me, do not have any reason to panic.
All right, this is a new week. So how do you see activities playing out this week? Will the bear still hold sway?
Well, we definitely, with the figures from the MBS coming in, there will still be more panic, but I think that may recede by the time we get to Tuesday or Wednesday. Investors will be able to see with a clearer vision after that time, and they will know that the reason for the economy is not because of their investment in the equity, and their investment in equity may not really be impaired much by what we are seeing in the MBS report. A sharp drop down in the external reserve of Nigeria is a major concern, but I believe also that with less pressure on that, we may be able to at least get things better. So everybody has to be on the lookout and be at red alert. I believe that the old downward trend cannot last all through the week.
Okay, I share that optimism, Rotimi. Thank you. I wish you a profitable trading day. Okay, let's look at the debt and currency market. Activity levels remain subdued in the Treasury bills market as investors remained wary of the low yields on offer. Nonetheless, the average yield across both segments of the market paired by 3 basis points to 0.1%. The contraction in the overall yield was driven by the almost secondary market, where average yield declined by 6 basis points to 0.1% as local banks invested maturities in mid and long tenor instruments. Average yield at the Nigerian Treasury bill segment was unchanged at 0.1% as the market traded quietly through all trading sessions of the week. At the bond segment, the bulls dominated as the average yield across instruments declined by 11 basis points to 4%. Okay, let's talk to Bosun Obembe, fixed income dealer with Access Bank. Good morning, Bosun. Thank you for joining us.
Good morning, Chimeze. Thank you for having me.
So what are your expectations from the primary market auction this week, and how will that shape sentiment for the week?
Okay, so for this week, we have annual maturity tomorrow about 103 billion. And like you mentioned, so this week we have a maturity in NTP. We have about 150 billion maturing, where DMO is only rolling over 130.6 billion. So there is a 20 billion shortfall from the 364-day B. So I expect the stop rate to be at the same level. The last auction we have in 91-day trading at the stop rate was 0.035, and we have the long end at 0.3. So the rate is already low, and even in the secondary market, we're already seeing a negative yield on some securities. So I expect that the rate will be at a similar level to what we witnessed the last auction. So even though I expect a lot of demand on this paper, but the rate will still be, I don't expect a negative return, maybe stop rate at this auction. And the market, like you know, that today we have MPC meeting today, so the outcome of today will actually determine, will play a major role in what the stop rate will be currently.
All right, Bosu, we appreciate your time. Enjoy the rest of the day. And with that, we draw the curtain on today's edition of the program. Thank you for watching.